conditions. I think we'll still see that today in the past conference, but there may be some nuance to the chair's message. And again, I want to say from what we heard.
You're right, guys. Bear with us. There we go. Let me get the links out. Beautiful, beautiful, beautiful. Yeah, as you can clearly see, we are getting prices pushing up. Just before this interest rate decision, we're very much at resistance. Okay, so yeah, let's see how things kind of play out here. Yeah, obviously we got this kind of price compression. It wasn't really. It was just literally tested once and then just continued up. It was looking extremely bullish. But altcoins weirdly have held. But we are getting obviously momentum, buy side volume coming in, spiking up. Yeah, we could push past this level. So something to bear in mind. That's for sure. Also, apologies, I didn't get round to hopping on the New York Open live stream. I had something pop up, so I couldn't be there. But I mean, this is the important one anyway for today. So we've come a little bit earlier than what we normally would. So yeah, let's see. We got 19 minutes away from that Fed's interest rate decision. Yeah, let's see what we can get. Again, we're expecting 0.5 increase. So let's see how things play out. It's the speech where we kind of get the important part of today. Really, it's how Jerome Powell comes in and what he says. Really, that's it. Yeah. Clearly, markets are taking everything positively, as you can clearly tell. Got a rally. Not only in crypto, we can see that the S&P is up, Nasdaq's up. Yeah, equities are up. So let's see how things map out. In terms of trades, this is one that we sent out. So let's see if it can break out very much kind of in this zone here. So if it breaks up either way, it's going to go very, very fast. And then we got a few others. But yeah, we'll see how things kind of play out here. Yeah.
That's the credibility issue. Does the Fed have the credibility to say we're still not going to cut, and will the market actually listen because the market is pricing?
Those are just joining us, welcome. Yeah, let's take the point, but we can definitely expect some price action today or in this live stream. That's for sure. We're already getting price action. Prices broke out, boom. Broke out structure. Now we are at some very nice resistance. Obviously, we got all the way to the top here, so we can get an overextension ever so slightly, which could be the case. So it might be that we need to play these longs very quickly, get in and out. If things start to really stop and wick at this point here, then that's your sign to get out longs and then potentially look for a pull down. Ideally, we would have wanted prices to kind of still be compressing ahead of this speech and interest rate decision. That would have been a lot nicer. It kind of gets a little bit dangerous as when we're at kind of these strong levels of resistance, because if something's said that's bearish for the markets, yeah, I mean, things can turn very, very fast to downside. So just bear that in mind. If you are long on positions, I mean, we are in longs. So yeah, we do need to be careful and aware of that. That's for sure. But yeah, guys, feel free to message us in the chat with whatever you wish. Those that are just joining us, welcome. But yeah, we're getting some likes on this live. Hello, mate. Hello. Welcome. Yeah, this is the official New York close live stream. Obviously, we've got the interest rate decision released in 15 minutes. We are expecting it to obviously be 0.5. Yeah, anything. I'm in gold, longs. What you think of that? Not a bad shout. Let me get something up. We'll have a little look. Yeah, I think we done gold the other day, and it just was building on some structure. I haven't checked it since. This was probably a couple of days ago. So let's have a little look. Let's have a little look. If I remember right, it was on a slight rebound. Here we go. I mean, yeah, very nice buy sides, building on some nice structure. Yeah, not a bad shout. I mean, you're definitely in a strong level of resistance here. There's a lot of volume for it to kind of try and break through. But this is nice structure. This is very, very nice structure. We've got a retest of this level, continuation. So yeah, potentially come and test this top again. Sorry, not again, but come test the top. Just here. Yeah, building on some nice structure. That's for sure. I mean, it definitely helps that it's above these long-term moving averages on the daily. That's definitely a positive sign. Yeah. Looks good. Just need some buy side volume to come in. Not really got a whole load of buy side. Maybe partly because of obviously the reports that we're getting. Obviously over the course of yesterday, today. So presume once we get past obviously this interest rate decision as well as the speech, then there'll be a little bit more movement and direction. But yeah, this looks good. I mean, obviously it bounced off that 200, and now we're kind of above. So yeah, it could go. You've got a couple of levels. Definitely going to find some resistance at this top here at 1950. That's if it's able to push up nicely through here. But yeah, see how things kind of go. But the structure is nice, mate. Very, very nice.
That's where the terminal rate pricing is largely settling in, and that's why risk assets have rejoiced. But we've also had recession risks getting priced in, and I think the market may be a little too optimistic about how quickly inflation will decline. We think the terminal rate is likely to be higher than what's priced in, but the market might be also a little too optimistic about how quickly the recession is coming in. So as much as I think,
by the way, those that are joining us, welcome. Feel free to ask us anything in the chat. We're roughly 12 minutes out from the interest rate decision, and then half an hour after that, the Fed speech. The Fed speech is the important part of this evening and this week, really. Well, no, not really this week, but one of the important parts of this week. CPI was very, very important yesterday. Obviously, we got weaker CPI. Yeah, it's the speech. It's more than likely it's coming at 0.5, especially after yesterday's CPI reading. So I don't think it's going to divert from the 0.5. If it does, then yeah, that's going to shock the markets. That's for sure. Yeah, it's the speech. We need to see how Jerome Powell's coming in and how he's assessing the information that we're getting at. Tabby Cat, hello. What are we expecting, gents? Welcome, by the way, my man. Thank you very much for coming back and joining us. So in terms of interest rate decision, we are expecting the 0.5. I'd be very, very surprised, as well as the markets would be, if it comes any difference to the 0.5 increase. It's the speech really, and I think especially how much markets have been rallying and kind of they're looking at things a lot more positively. Partly because of how Jerome Powell came in on the last speech, right? It wasn't really much direction. It was kind of wishy washy, and it was kind of positive. So I think the markets are just taking things very, very literal, which I mean, at the end of the day, you should um, take what the chairman of the Federal Reserve says, right? It's his job. But he's not painting the picture how it should be painted, and more than likely how it will be painted. Um, yeah. So we could be seeing a more hawkish Powell today. It really does depend on what he says. So you can come in with a hawkish stance, but still not really um, putting the dirt on the table, if that makes sense. So, um, yeah, you're like isn't not painting the picture as dark and gloomy. Still providing markets with that little bit of hope, even if it's a little bit. I mean, from the previous speeches, from previous CPI reports, interest rates, markets have still, for some reason, pushed up higher on a lot of those reports in the past 3 months. Right, even on the 75 basis point increases. Even on changing expectations. Um, yeah. Hello, Alex. Is our Matic long still open? It is still open and it is in profit. So hopefully, it can continue. It's looking very, very nice, building on some nice structure. As you can see. Hopefully, I mean, if it closes, just test this level, pushes back up, or even, I mean, it's looking very bullish. So we could just absolutely blow through that previous structure there. But yeah, this is some nice structure. I mean, we are at a decent level of resistance here, as you can see. So it's just whether we can break through it. I mean, just look at Bitcoin. It's right at the top of resistance, right at the top of this ascending channel. So we could get a very quick, sharp move, boom, and then maybe come down. So we do need to be careful. We do really need to be careful of this. Ideally, going into this interest rate decision, we would have wanted prices to have been up here. Down here, kind of compressing, still leaving a little bit of room for movement at the top before reaching like a stronger level of resistance. Yeah, I don't know why your comment got deleted. I don't know whether you can delete the comments or somebody has deleted it because they're monitoring it. But yeah, we are in long on Matic, and yeah, it's going well. Let's have a little look. Yeah, I mean things are looking pretty sweet. Let's just hope we can make a push. Now on the higher time frame, it's always worth having a little check. As you can see, we've got that 100 moving average just sitting above. So it wouldn't surprise me if we push to that 100 or even slightly past it, and then see a whole load of supply being dumped and moving down. But yeah, I mean this is a strong move. Yeah. So yeah, we do need to be careful of how we are treating any potential shorts.
that's posed quite well. Let me think out loud. I think growth will downshift below trend. I guess the surprise, John, is we had a downshifting growth through the first 3 quarters of
So Ethereum's got a little bit more room on the top. Okay. Yeah, but it's tweeting around that strong level. But we're not still yet seeing too much supply being dumped. What we need to see is that supply. We need to see wicks on the top, and we need to see that the sell side coming in on the. I think my connection is bad. Can't hear you well, but I got my answer. My chat message has the word moderated. Yeah, see, it's TradingView. It's very strict. We've been banned a few times for having our links on the screen. So yeah, they're very much on it. But yeah, you got your answer. You can't hear me. Can everyone else hear me, or do I need to change my inputs? If not, then I'll try and get.
To regain some sort of, I don't want to say control, but greater influence over the market pricing of these types of things.
Yeah, it's an excellent point. If you Lisa, if you compare the September projections with the March projections, they were definitely a move in a more realistic direction. So I believe in September, the committee, the median participant, had the unemployment rate rising to 4.4, which would be about a 1 point rise over the lowest level that we've seen. Now, historically, we all know the Dudley rule of thumb, which is if you get more than 4/10 rise in unemployment in the past, it's always been a recession. So I would argue implicitly, although Chair Powell may not use the R word today, their forecast is more or less consistent, I think, with a modest recession.
I'm sure the video quality is too high for my connection. Has been really bad for the last couple of days. Yeah, mate. I feel you on the connection. Luckily, obviously, we've managed to actually sort things out. But yeah, I know that feeling. It's not the best of feelings, to be honest. But yeah, hopefully you can kind of hear me. Yeah.
It's low. I mean, I should say the market is less liquid. So we get these really wild moves, very hard to pick a narrative. You talk about confidence on the market. With a market that's less liquid, it should be a little lower. I think this year has taught us all humility, and certainly me. But in terms of confidence, I go back to John's question on growth versus inflation. I think my inflation uncertainty is going down. I am concerned about service inflation. Growth uncertainty is what is going to continue to pick up. And so that's when going into the middle of next year, I mean, have we reached terminal? When does the Fed respond? What is the threshold? I hope Jeff Powell can explain what's the threshold for the Fed to stop versus, slow down.
Right, we're 2 minutes out from the interest rate decision. Whew, let's go.
We're going to see weaker growth data for sure. And then we're all going to look at the Fed and they'll say they're resolute. And that's going to be very hard to trade for any asset class.
Ooh. Now we're starting to see some supply being dumped here. So be careful. This is going to be definitely choppy here. Very choppy. All right, we've got 1 minute.
It's certainly not unwarranted. Look, inflation is public enemy number one. We got two data points in a row on inflation, and so yes, there's obviously a macro input. Calibrating how much of the easing makes sense in terms of a model. I mean, that's a matter of judgment. But I think we're going to continue, John, to see this tug of war between the data and the Fed really throughout much of next year, because their models are telling them to succeed and get inflation down into the twos, they need to keep policy restrictive. But if markets keep easing financial conditions, the restrictive policy loses its bite. So stay tuned. This is going to be with us for a while.
We're going to find out in the news conference, I think, in just 30 minutes' time, Tom. Priya Misra, Richard Clarida, to the two of you, absolutely brilliant.
Yeah, thank you.
As always, going into this Fed decision. TK, there's going to be some questions about that in the news conference, no doubt about it.
Priya Misra, the single smartest thing I've heard in the last 24 hours, and it goes to all this Bitcoin crypto malarkey we're talking about. She said humility is in order, and the distinctive feature at this central bank are frontline academics like Richard Clarida and DSG. I mentioned Rick Michigan, his colleague at Columbia.
All right. So it was 0.5 as expected, guys. 0.5 as expected.
Over how hard this is.
I think also scarred by the experience of the last few years,
Yes.
and at least of the last 12 months. 12 months ago, looking at 12 months, how wrong could we be about where many people thought rates would end up the year?
Yeah, I don't think anyone needs a lesson in humility. I think everyone's gotten one, and I think that
Conditioned by it.
exactly, and I think that there is a feeling of exhaustion more than anything right now because people feel like, okay, well, we don't know what's coming. We don't want to have a downturn. We're exhausted by all of the negativity. We heard that earlier today, and yet, how positive can you be with a 4.5% to 5% Fed funds rate for a longer period of time?
If I sat here 12 months ago and said we'd be staring down the barrel of a 5 handle on Fed funds,
People would laugh at you.
and they would have laughed at me 12 months ago, right?
Yeah,
That just was
people
not
did.
on the radar.
I mean, we have Bill Dudley. He's coming up, and people.
Right, let's get rid of this anyway. But
We're not going to get there.
He's going into this decision. 3/4 of 1% on the S&P 500, up 0.7%, 7 or 0.8 of 1% on the Nasdaq. With your Fed decision, here's Mike McKee.
This is a hawkish Fed, as expected. A 50 basis point move to between 4.25% and 4.5%. But the median dot for the end of 2023 is 5.1%. That implies that rates will go up another 75 basis points. And 7 of the 19 members thought they should go higher than that. Not what global Wall Street is expecting. Supporting that outlook, there is no change in the Fed's statement's promise that ongoing increases in the target range will be appropriate. Rates start to fall in 2024. The median forecast
Come on.
that year, 4.1%. Although there is a lot of division, the forecasts range from a low of 3.1% to a peak of 5.6%. Rates then drop to 3.1% in 2025, although it's at 5.6% in 2025. The long-run neutral rate unchanged at 2.5%. The new economic forecast downgrade what is now seen as modest growth as the Fed tiptoes close to saying we will have a recession next year. For inflation and unemployment, GDP for 2023 is seen at only 0.5 percentage point, down from 1.2% in September. 2024 is trimmed by 1/10 to just 1.6%. Employment ends next year at 4.6%. That's 0.2 higher than the forecast.
Let's go.
September. Same for 2024. Inflation remains elevated, the statement says now, with no acknowledgement of yesterday's increase in the The Fed uses PCE inflation. Median forecast is 3.1% by the end of next year, although that is higher than they thought in September. 0.8%. It drops to 2.5% in 2024, 2.1% in 2025. Core inflation next year falls to 3.5%, up from September's forecast of 3.1%. The decision unanimous, so a much more hawkish Fed, at least coming out of the statement, than we had anticipated.
And of course, this is only the news conference still to think about that as you work through the price action. But based on the price action so far, not much of a move. We're down 0.4% on the S&P. We're down 0.5% on the Nasdaq. Into the bond market, yields come lower, not higher at the front end. We're down about a basis point at the moment to 420. It's a bounce off session lows, but on the day still we are down. Tom, that is a move on a median dot for 2023 from 460 to 5.1. It is what we heard from Hansius over at Goldman. From Holland West over at
That news moved prices, yeah.
I'm sorry, John. 4.9% is not the same as 5, and 5 is not the same as 5.1. The emotion to the market every tenth of a percentage point on that level is important.
So Mike talked about the outlook for next year for real GDP. That forecast for 23 is now only 0.5%. The September projection was 1.2. If you're looking at unemployment, they've now got that at 4.60. The dot plot for next year. Lisa, they now see PC inflation for next year, 23 at 3.1 from 2.8.
I don't understand why the reaction market isn't. And the knee-jerk reaction is a hawkish Fed after a lot of people were talking about more nuance. There is no nuance here. This is very clearly a hawkish Fed that would like to keep rates above 5% for a lot of next year. That is a very different message than what the market has been telling us.
Can I go to a quote from Alan Ruskin at Deutsche Bank from yesterday? Alan coming into this said this: the market will probably also take the Fed's higher end 23 dot as a way the Fed not expect to cut rates in 2023.
Right.
Will continue to view with skepticism. Now, Tom, this can all, of course, change.
This goes
In the news conference in 26 minutes, but are we seeing that element of skepticism push back against what the Fed's trying to signal?
I defer to Professor Claire on this, and president of a central bank doing what the market's analyzing right now. We made a joke 4 days ago about a hat trick of pivots. I think we were talking about pivot one, pivot
That's a
two.
three-part story.
That's a three-part
You
story.
step down first, and then you pause, and then you cut. And clearly, they're focused on the step down, never mind the pause, and certainly not the cut. Let's wait for the news conference and see how changes.
All right, we came back and tested that structure. So we'll see how things kind of play out. But that's your first sign of supply being dumped. As you can clearly see here, that's a decent move. So, yeah. Got a decent move. A lot of red.
Scott Minerd has decades of experience. He's global CIO of Guggenheim Partners, but he has an ability to blend the econobabble in with all else that's out there as well. Scott, I got one headline. Fed officials see 0.5% GDP growth at the end of this year, at the end of 22. I mean, I'm looking at incredibly slow growth. I'm not hearing that from Ed Bastian at Delta. I'm not hearing that from Scott Kirby at United Airlines. I'm not hearing that from economists tuned in to a healthy. Does the Fed have the GDP slowdown right?
I think, Tom, if anything, 0.5% is probably overly optimistic. When you look at how monetary policy would be based upon what they just told us, and funds rate at the end of next year, when we have an inflation rate at 3.1, that's pretty restrictive. And when you start to look at what it's going to take to bring inflation down, our in-house estimate is that we would probably see about a 2% rise in unemployment over, a 2-year horizon. So the numbers don't all add up.
That happened. When of this is, I think, maybe this is the when Fed meeting, Scott. We're trying to figure out the when of it all, aren't we?
Right. You're absolutely right, Tom. I mean, the question I said yesterday is, how far will the Fed go? How long will they stay there? When will the recession come? When will they reduce rate? That's the whole narrative here, I think. And, the message that's sent today, I think, is the message that the market expected. Is, we knew they had to be very hawkish. And the reason they have is that financial conditions have loosened pretty dramatically over the last 6 weeks. The stock market's up substantially. Rates are down.
All right, we've got to close some of these logs. That's some dangerous move.
Because the economy pick up momentum again,
by 5 basis points now to 427. If you just go through the details of the projections, typically when we break this down, we look at the median. I'd say shift along the SCP range for 23, range of estimates, 49 to 56. I have to say here, Scott, 49 to 56 probably wouldn't be the range I expected. Are you surprised by how tightly bunched these Fed officials still are looking into 23?
Let's see how things
I'm not surprised in 23. You know, what I was surprised
play out here.
I think the dispersion is as we get out further.
That's some weakness right there. So I guess we're just going to see how things kind of play out. This is your trade, well, to go short. That's what we've taken. Hoping for a breakout of this structure here. If we do get a very, very nice potential move all the way down to this structure 1.4. That's what we're looking at anyway.
Data that we're getting that is showing that deflation is decelerating rapidly, and some parts of the economy are falling to deflation. They're completely discounting based upon wage growth. And I candidly, you know, when I was an advisor to the Fed 5 years ago, the whole discussion was around how do we get wage growth to go up. Now, for some reason, you know, wage growth is bad, and is this President Williams said, you know, is the core of the onion. I think that that's not the appropriate perspective the Fed should be having.
So, Scott, if you don't believe what they're selling today, from your perspective, is that bullish or bearish for this market?
Well, it depends. I mean, for rates, John, it's bullish. For the stock market, I think it's bearish because, you know, we've never seen a stock before the Fed stop cutting rates. So, you know, I think longer duration Treasury securities are a great place to be. High quality corporate bonds are probably, you know, an okay place to be because you'll get lots of income off of them. But you know, high yield bank loans, real estate, you know, stocks are all probably things that are going to continue to come under pressure. And you know, that's the position that we're taking. The other question is how far will the curve invert? You know, 2s, 10s could get to 100 basis points, but if the Fed is caught offside and inflation comes down harder than they expect and the economy stalls out, you know, the likelihood is that we could get a curve steepening in the second half of the year. But for now, the inversion is probably staying with us.
As people digest the statement, we are seeing a bit more of a predictable response. We now see the NASDAQ down 0.8%. Two-year yields are now higher on the trading session to 4.3%. Still, nonetheless, not massive moves considering how much some of the projections went against market expectations. Let's bring in Diane Swang, Chief Economist at KPMG. Diane, from your vantage point, is it notable that the market is not buying what the Fed is selling and that they're still pricing in Fed rate cuts by the end of next year?
I think yes, it is notable, and I think there's two things going on. One is the speech that Chair Powell made, the last speech he made before we got this, was very hawkish, yet his Q&A that came out of that was much more nuanced and less hawkish, and I think that set the stage for, even if they go in hawkish with these SEPs, the Summary of Economic Projections, and a more hawkish move by the Fed, that it could be tempered by what Jay Powell says. I'm not sure that's going to happen, but I think there's another issue that's very subtle, and I want to just take a little issue with Scott. I love Scott, but the Fed is not against wage gains. What they're trying to do is bring down inflation more rapidly than they bring down wages, so that wages ultimately outpace inflation. Right now, we do have a situation where they're concerned, whether they're right or wrong, they're concerned that there's a floor on inflation because of how high wages are, and a lack of productivity, and moreover, that the job shortages,
yeah, that price action is not nice at all.
Cyclical in nature. That means a higher non-inflationary unemployment rate going forward.
And we got a bounce on the DXY as well.
They were going for 3.5% unemployment again because that's
huge.
in February
Huge move indeed.
That is no longer the case. And however the costs are coming in, whether it be the number of people who are out ill and unable to work in any given month in this endemic, which is going to rise again in December, running 70% above pre-pandemic monthly averages in November. That causes staffing shortages, adds costs to the system. It's why they're focused on the labor market. Trying to hammer wage gains per se. They're trying to hammer inflation and bring that down more rapidly than they bring down wages, so we get inflation-adjusted wage gains.
John, two observations here, and I think you are absolutely dead on. In our history of doing this, it goes back to Arthur Burns. I can tell you, John, I have never seen a Fed decision in a market reaction on the Bloomberg terminal that awaits the press conference. This one.
Kind of striking it off, isn't it?
That's all there is. Neil Dutta published this here moments ago. I am sorry, but that is too low. Speaking about the GDP projection that I talked to Mr. Minor about. I am sorry, but that is too low. Current quarter GDP is healthy, and there is limited downside at this point. I think he was flying Delta Airlines when he wrote that.
Neil messaged me.
Yeah, well done for breaking out break even. Yeah, we made a very small loss on that. I think it's like 20% or something, but yeah, no, that's way too. That's a dangerous move. That right there. Yeah, we've closed out our shorts. That's an indication that potentially you're seeing a very, very hawkish Jerome Powell coming in here. Especially where prices are. I mean, literally right at resistance, perfectly at resistance. That's a very, very large supply dump at a strong point of resistance. So yeah, we could be looking at a very, very large turnaround in the market now. Yeah, I mean, just look at that. That could be the top for now. We could be looking at a very, very large move. Lost all my profits, but didn't lose more. Yeah, that's fine. Don't worry. Yeah, that's perfectly sweet. Yeah, that's a week and a half. Those that are here with us in the stream, let me see how many of you are in here.
Or is it something that's more prolonged and they slowly grind inflation out of the economy?
That's a huge red candle. Lots and lots and lots and lots and lots of volume.
How wrong do you think the market is right now, given the data that we got yesterday, and given the fact that you do see resilience with also this disinflation that was apparent?
Well, I think that, look, if we just look at S&P earnings and, the cost, adjustments that are coming through because of inflationary pressures and, the slowdown in the consumption, it's not hard to predict a 10% decline in S&P earnings. So, that would take us from $220 to $200. And that's pretty mild. Then, you take the average multiple.
Bloody hell, the soul's on mad one.
In a recession, and you say 15 times, that's 3,000. If you want to be generous, you say 16 times. But, we were a long way from that sort of a level today. And, I think that once we get through this seasonal rally that we're living with, and the relief rally that we got from the last meeting 6 weeks ago, I think that we will renew the downtrend, and we still haven't seen the bottom for stocks.
Yeah, I love that the seasonal rally that we're seeing right now. What would it do to this economy if rates were held at 5.1% for the bulk of next year?
I think it would probably put us into a pretty severe recession. At least I have to say that one thing that I am always driven by historical data. Tom can speak to that. And the one piece of historic data that I can hang my hat on here is the Fed has consistently been wrong in its projections. So I think that
can you sugarcoat that, please, Scott? I mean, can you be less direct? Thank you.
I think that if we actually
What the hell is up in there?
become a 5.1%, as the Fed is saying, then we would probably push the economy into a pretty severe recession, because as inflation falls off, that becomes a highly restrictive monetary policy.
Hey, this is the debate right now. The debate, the tension between what this Fed is trying to signal and what people believe is achievable.
Yeah.
And so between people like Scott and this Federal Reserve, there's a bit of a spread at the moment, that's for sure.
The eclecticism of our guests and their different opinions, I'm going to go to, this is something that Neil Dudd has talked about, and Michael Darda.
Crazy moves.
We are so wedded to a real analysis, an inflation-adjusted analysis, including your wonderful show, The Real Deal.
That's a huge shakeup.
There's a nominal analysis as well.
Everything's wicked.
A decision where you get some growthiness maybe in GDP, but far more inflation stays sustained and unemployment doesn't move. And all of a sudden, you've got an animal spirit built.
Right, we're 10 minutes out from this speech. We will get it up here for you. So those that have joined us, yeah, I'll have it up here for you.
In the statement. One was whether this line over ongoing increases would shift. This is what it says now. The same thing. The committee anticipates that ongoing increases in the target range will be appropriate. So that stays in there. So that's the statement down with 50 basis point hike. The statement doesn't change too much. Then you go to the projections. The projections, the 23 dot has shifted from 460 to 5.1, and that's getting everybody's attention. Widely anticipated. That's a shift from September, from the September projections to the fresh December projections. There's been a big cut to GDP growth. We've come down from 1.2% to 0.5%. The likes of Neil Dutter pushing back against that. And a price action, well, it's shaping the market up as follows. On the equity market on the S&P, we're down by 0.4%. On the Nasdaq right now, we're down by about 5 or 0.6%. Lisa's shaking her head to some of the equity market action. In the bond market, yields are up by, let's say, 3 basis points on a 2-year to about 4.25 on a 10-year, Tom, to 3.52, up a couple of basis points. We're about 9 minutes away from Chairman Powell and his news conference.
And again, as I said earlier, I think more than anything in months and months in Fed meetings is this press conference is going to be absolutely fascinating. We just had a great chart up on radio. It looked great on radio as well. Karen, bring up the real GDP chart again. John, here's how the pros do it. You take 1.6% 2 years out on the edge of Andrew Bailey. What's he going to say tomorrow? 1.6%. And you add in some form of inflation of 2-ish, and I've got 4% nominal GDP in a heartbeat, which is not, that the animal spirit is there to keep this thing going.
Is that the path to a real recession, Tom?
No.
Those numbers.
That's my point.
Yeah, the 5% Fed funds, getting inflation down to 3%. Get inflation down to 3% with 5% Fed funds. How much damage do we do?
Sarah House, a conversation this morning. What do you do with 3%? Then what? What's the then what?
She said it's the last mile, and the last mile is difficult. Dan, can we speak to you about that? The last mile.
Yeah,
getting it down. Never mind 7 to 5. The next push.
That's exactly it. The fact that
yeah, by the looks of it, we are going to go down route. I mean, just look at that. That's some crazy sell side there. Some mad sell side. 16. Let's see if we can break through these levels here first. Yeah, I mean, if we can, 16. I mean, if we come all the way down to 16, we'll be breaking all the way down. Yeah.
where their credibility is at stake and where they're worried that we could have a more corrosive bout of inflation that takes root in underlying economy and that you can't eradicate the economy of the inflation we have. That's a very, very important message they're trying to send, is that they're not going to stop at 3%. With that 3.1% at the end of the year, how hard they believe that last mile is to go from 4 to 2 is in that forecast over years that they're talking about bringing it down.
Diane, let me just give you some Twitter feedback that I've gotten. Legit 0% chance that it's 5.1% at the end of next year. That was basically one comment, which is pretty much in line with what the market is saying, that we're not even getting up to there in May, which may be the peak of Fed funds. So, Diane, from a messaging standpoint, this Fed has already lost a lot of credibility. And there's an issue of, can you deal with the political backlash as the unemployment rate raises to the levels that you're talking about? How would you push back and say this Fed is serious when it has not been tested? And honestly, its past precedent has been exactly as Scott has said, which is they've gotten it wrong and the market's gotten it right.
Well, I think that's very important, and the Fed's credibility is at stake. That is absolutely where they're at, and I think they know that. This is the cardinal sin of a Federal Reserve, is to allow inflation to go, and then also not be believed that they'll take it down the whole way. Now, they could be wrong, and I have to think they're wrong too, but I understand where they're at, and this is part of the risk management and pushing back on the market, expecting them to cut sooner. They don't want to they are more than willing to start cutting rates if inflation comes down more rapidly. They have to send this message right now, and I think that's where they stand. They will be a political pinata. I have no doubt about Jay Powell's ability to handle the politics given what he's already been through.
And now your economic lesson of the day, folks, from the halls of Michigan economics. We asked Diane Swank, what in God's name, Diane, I mean, is this like a word, is Brainerd using this word to capture the calculus of 3 or 4 or 5 meetings of action? What's it mean?
Well, it means not only the fact that we've had cumulative rate hikes in the United States and over time. For instance, vehicle loan rates are lagging overall Fed funds rates. So over time, we'll see even more increases, 4 to 5% in vehicle cost of financing a vehicle and buying a vehicle. Just even what the Fed had done before this meeting is still baked in the pipeline. And so over time, that starts to accumulate and be larger. But also, it's the spillover effects. And I think that's the key that Brainerd brings to the table, and the diversity within the Fed in terms of perspective. She was there during the taper tantrum at Treasury in 2013. She knows that there's spillover effects from what's going to happen in the rest of the world. And that's where she's thinking of those cumulative effects.
Scott Miner, I have 3 different messages in, and I'm going to do this 4 minutes before this press conference, and I'm going to go off topic. You are acclaimed as a student of what we're living in crypto and Bitcoin. Do you have confidence that system can move forward?
I do, Tom. A year ago, we were talking about crypto, and there were approximately 19,000 coins. To which my comment was, this is mostly crap, and there's going to be a washout. And just like the internet bubble, we will have survivors. And, the digitalization of currency is just in its infancy. And, how this evolves now is going to require, a regulatory framework to legitimize it. Yeah. And I think we will move forward, and I think this will be transformative in the general economy.
Lisa would like to weigh in here, Mr.
Well, I don't weigh in on this per se, but there is a question of whether the whole FTX phenomenon really was born out of the easy money policies, and whether there are a lot more shoes to drop in the financial stability aspect of this. As everyone talks soft landing, and as we talk about disinflation, how much less of a chance is there of that outcome, which I know you've been talking a lot about?
In terms of the collapse?
Yeah, some sort of, more financial disruptions, shakeouts, that things going to zero that were overnight, that were worth tens of billions of dollars.
Sure. I mean, look, I think there's more to come, Lisa. And the reason is that, this is just like any number.
Like a short on Zil.
And a lot of speculation. And so
holding this level nicely. Kind of head and shoulders there, broke through.
Obviously something that was crazy. NFTs were, I never quite understood them.
I loved them. The one they did of me was just great, Scott. It worked out top of charm.
But the you look at what happened with the Bank of England. We averted, I think, a global financial crisis there. Quick response. So there's, I think, another shoe to drop, and I can't tell you where it is.
Thanks for the people. Thanks for the people.
All right, we'll relax and just watch price action as we get this speech now. Yeah, let's see how things kind of play out. Yeah, but yeah.
Is crypto and Bitcoin part of my zombie view for 2023? Mr. Minor was alluding to that.
For when you publish the Outlook, Scott, always awesome to catch up, buddy. Scott Minor there alongside the
Let's have it. That's some crazy supply being dumped at that level there, though. And that's exactly what we were waiting for. Exactly what we were waiting for. We didn't get it here. It pushed up just prior to this interest rate decision. Interest rate decision came in, I mean, as expected, but bloody hell. They must be expecting the Fed to come in hawkish. Maybe they were thinking... maybe they were waiting for, expecting interest rates to come below 0.5 off the back end of the weaker CPI reading. Gotta go. My connection is getting worse. Catch you all later. Thanks, Alex. Cheers. Yeah, thank you, Root. Thank you. Yeah, wish you all the best, mate. But I'm sure we'll see you soon.
Maybe it's the crypto stuff as well. But all of a sudden, John, we're where we were 12, 13, 14 years ago, and we're getting used to it again.
We're still assessing the damage. The damage from a really, really quick rate hiking cycle. 400 basis points plus. In what time? 9 months? And there's still a massive debate right now as to how much damage this will actually cause in the first half of 23. I get the consensus, but you've got people pushing back against that view. Neil Dutter's one. That's just one. Max Kenner of HSBC is another.
Ed Hyman today was brilliant with Paul Sweeney on this, and he said, look, the shock that we've had is tangible, and Ed Hyman's falling back to what he does, which he looks at the microdata of America. And he says, it's not all that bad.
Chairman Powell, a little bit late, son. Just a few seconds.
I can't imagine. I don't think Morocco's going to get it done.
Surely he's not.
You think he's in watching?
I don't think he's watching. Is he a football fan?
I don't know. He's 26 seconds late.
I am wondering if we get the same performance we got in November, or whether it's changed. I go back to those comments from Rich Clarida. Has the risk assessment changed on the outlook for Fed funds? Here's the chairman of the Federal Reserve, Jay Powell.
Here we go.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, we raised our policy interest rate by a 0.5 percentage point. Ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive over time. We're continuing our balance sheet. Will likely require maintaining a restrictive policy stance for some time. I have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of a longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
So look at that, the S&P, all of these equities are fully coming down. Sorry.
As it erodes purchasing power, especially those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy.
Just tell them that you're going to push it higher.
Over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Didn't really say much, did he? This is the important part when they actually get asked some important question.
Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves. And many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that were published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina Smiley, New York Times. Thanks for taking our questions.
The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we're moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do.
That's what I want to hear. A little bit more of that.
At some point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it. So we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates, and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed.
By the way, those that are joining us, welcome to the stream. Officially, the Fed speech. I mean, we're not getting a whole load of much, to be honest. Yeah. Obviously, we got a bit of price action that's come down. We're kind of literally just hearing exactly what we've been hearing. So.
I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off. Other than the tech companies, which is a story unto itself, generally companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that did come out last week, do you think it will change some of those forecasts in today's estimate?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, but well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you, Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SCP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So
I've heard enough anyway. It's literally not saying much. It's just the same stuff every meeting. Yeah, I mean, it's not exactly extremely hawkish. It's what we got the last couple of meetings that we've had, if not 2-3 meetings ago. Rates are going to be held for higher for longer. Waiting on data. There's nothing really new. So I guess even though we got 2 better CPI readings and he's still coming in like this, that's what's considered as hawkish, I guess. You got your information. Obviously we got a nice push down in prices. Very, very nice amount of supply. Now it could be the case that we do push up again. And then dump, so be careful of that. But yeah, I mean, got 1, 2, and that's a lot of sell side there. A lot of sell side. Equities have completely turned around as well. It's exactly what you want to see. So, at strong level of resistance at the top of the ascending channel. There's a whole load of confluences here. Indicating that things are going to come down. Looks like we might get a bearish engulfing on the 4-hour. Again, another very bearish signal. We could be pushing down very, very heavily soon. Guys, that's it. In terms of our shorts, take a short either on Bitcoin or Ethereum. You can place a little bit higher leverage if you wish. I don't see it going past 18.6. That's probably your top. If it pushes past, then yeah, it's going up higher, but this is more than likely to be your top. If it comes up again, then yeah, probably see 18.6 hold. But yeah, this is looking good. So short. But yeah, anyone that's joined us, thank you very much. We'll touch base with you all tomorrow for Thursday. We'll see how things kind of played out over the course of tonight, and we'll start again tomorrow morning. But yeah, thank you very much for joining us, and we'll see you in the morning. Cheers.